Welcome to the Opening Bell Report.
Today, we're cutting straight through the noise surrounding RIVN Automotive. That's REN.
And there is a lot of noise right now.
There is. We're looking at the situation as of January 16th, 2026, and honestly, it feels completely contradictory. The stock's hovering right around $17.
And it took another hit today, down about 2.5%.
Exactly. And the headlines are just screaming sell, all driven by these recent analyst downgrades. So our mission is to figure out if that fear is justified.
Or if something else is going on.
Right. Is this price drop a massive oversight, maybe even the sale of the year, because the market is, ignoring a huge operational catalyst that's happening right now?
It's a classic disconnect. You have Wall Street, firms like UBS, Wolf Research putting out these downgrades.
And that spooks people.
It absolutely spooks the retail investors. They see the headline, they panic, and they sell. They think the ship is sinking.
It's pure emotion. It's all based on yesterday's numbers.
Exactly. But then you zoom out. You look at who's actually holding the stock, the big institutions, the strategic partners, what we call smart money.
And what are they doing?
They seem, completely unfazed. You're not seeing them dump shares. If anything, the data suggests they might be quietly adding to their positions at these prices.
So we're diving in on the idea that this fear-driven price is maybe a temporary glitch, a flash sale hiding some serious long-term value.
Let's get right into it. The place to start is the factory floor, with the one piece of news that really counters all this pessimism.
Okay, let's do it.
So just yesterday, January 15th, CEO RJ Scaringe gave an update. And he confirmed that R2 validation units have officially started rolling off the production line.
In Normal, Illinois.
In Normal, Illinois. This is happening now.
Okay, let me play devil's advocate for a second. Validation units. That's not the same as customer deliveries, right? There's still a ton of risk in scaling this thing up.
That's a fair point, it is. But for an EV maker, this is the signal. It's the proof of concept. It tells you the factory retooling works, the assembly process is sound.
So it kills the biggest fear the bears have had.
It completely debunks it. The fear has always been production delays. This update confirms that R2 deliveries are squarely on track for the first half of this year, 2026.
And this is huge because the R2 isn't just a new model, it's the whole pivot point for the company's finances.
It's everything. Let's talk about the product itself. This is their mass market play, a compact SUV.
Starting at what, around $45,000?
Around $45,000, which opens up a massive chunk of the market they couldn't touch before. But they're not holding back on the performance.
No.
The tri-motor version is supposed to do 0 to 60 in under 3 seconds.
Which is just insane for an SUV at that price.
Yeah.
And it's aimed squarely at the biggest fish in the entire automotive sea.
The Tesla Model Y. Currently the best-selling car in the world, period.
So they're not going for a niche anymore.
Not at all. The R1 series, that established the brand. It's premium, it's adventure. The R2 is designed to establish them as a high-volume, profitable manufacturer.
Let's dig into that, the profitability. Because that's what the analysts are missing. The R2 is built on a totally new, cheaper platform.
And that's the key. It's all about simplification and scale. I mean, the R1 platform was amazing, but it was complex, expensive to build.
So the margins were thin.
Very thin at first. The R2 platform is optimized for manufacturing. They've done things like completely redesign the wiring harness, which was super complex in the R1. They've also cut down the number of ECUs, the little computer brains, that run the vehicle.
Fewer parts, simpler assembly.
Equals a lower cost of goods sold. They can make a real profit on a $45,000 R2 much faster than they ever could on an $80,000 R1.
That's the path to profitability everyone's been waiting for.
It's not a theory anymore. It's an engineering plan that's literally rolling down the assembly line.
So that explains the math, but let's talk about who is betting billions of dollars on this vision. Who are these quiet giants ignoring the analyst noise?
Well, you have to start with Amazon. They're not just an investor, they're the biggest shareholder. They hold about 13% of the company.
That's around 158 million shares.
And they haven't sold a single one through all this volatility. They have not flinched.
And Amazon understands scale. They understand logistics and tech infrastructure better than almost anyone. Their conviction means something.
I mean, think about the due diligence they've done. This isn't just a portfolio manager buying a stock. This is a deep strategic bet on Rivian's core technology for the long haul.
And it's not just them. The filings from back in November of 2025 showed that huge funds, the really conservative ones like Vanguard and BlackRock,
They were adding.
they were increasing their positions, buying more shares before this latest dip.
It's the classic split. The long-term money, the people who value the patented tech and the platform, they see a buying opportunity. The short-term traders see a scary headline.
And that technology platform they value so highly brings us to maybe the most important piece of external proof.
The Volkswagen deal.
The billion-dollar validation from VW.
Yeah, this really connects the dots. The joint venture, which is called RV Tech, is now a year old. This is not just some press release. It's a deep, active collaboration.
And the sources say there are, what, 1,500 engineers working on this?
1,500 engineers from both companies. That's a serious commitment of resources, and we are seeing the results of that right now.
How so?
This quarter, Q1 2026, Volkswagen is starting winter testing on their own vehicles.
On VW vehicles?
Yes, using RIVN software and electrical architecture.
Right.
They are actively integrating the tech and stress testing it in the real world.
So why would a giant like VW pay billions for this? What did they actually buy?
They bought the brain. They specifically invested to get access to RIVN software and their decentralized electrical platform. It's something legacy automakers have really struggled with.
So VW is essentially fast-tracking their own EV software development by plugging RIVN's proven system into their cars.
Precisely. It's a massive cash infusion for RIVN, sure, but more importantly, it's this giant external stamp of approval on the tech that the bears claim is too expensive or unproven.
Okay, so let's tackle the bear in the room head-on, the downgrades. UBS specifically pointed to cash burn as the main reason for their negative outlook.
And we have to address that, because they're not wrong that the company is spending a lot of money, but they're missing two critical financial green flags.
Lay them out for us.
First, and this is the most important one, is the gross profit flip. Back in the third quarter of 2025, RIVN reported a positive gross profit of $24 million.
Okay, let's make that really clear for everyone. What does positive gross profit actually mean?
It means that for every single car they sell, the money they get from the customer is more than the direct cost of the parts and the labor to build that specific car.
So they're no longer losing money on the physical product they ship out the door.
Exactly. The unit economics now work. Now, they still have a big overall operating loss, and that's the cash burn number the analysts see.
But that's from other costs.
That's from R&D for future models, building out the service centers, and the massive upfront cost of tooling the factory for the R2. They're investing in growth, not losing money on their core business.
That completely changes the story.
It does. And the second green flag is the cash runway, all the fear-mongering about them going broke. They currently have about $7 billion in cash.
$7 billion?
It's a fortress. It completely undermines any near-term bankruptcy fears and gives them more than enough runway to get the R2 ramped up to scale without having to rush to raise more money.
So you're looking at a company with 78% revenue growth, proven unit economics, $7 billion in the bank. And it's trading like it's on the brink of collapse.
It's like the market is pricing in the old R1 cost structure, not the new R2 reality that's just around the corner.
And you see this confusion reflected in the analyst price targets. They are all over the place.
It is a stark difference. You have the bear case from UBS at $15. They're just focused on that short-term spending.
But the bulls are looking at a completely different number.
Completely. You have someone like Dan Ives at Wedbush, who knows this sector inside and out. He just raised his target to $25.
And he called the R2 a transformative moment?
He did. Tigris Financial also has a $25 target. So from where we are now, the bull case suggests, an almost 50% upside.
And what's the blue sky scenario if they execute perfectly on this R2 launch?
Well, the models that assume they hit their 2026 revenue targets, which are just under $7 billion, those point to a potential stock price as high as $39.
That's the prize. Okay, let's get practical. For anyone watching the charts right now at $17, what are the technicals telling us?
We're at a really critical spot. The support zone between $16.80 and $17 has held up for about a month now.
So it's being tested again.
It's being tested right now. And if it holds against this wave of bad news, it forms what's called a classic double bottom. It suggests the sellers are running out of steam at this level.
A potential entry point for buyers.
A strong one, technically speaking. The first major resistance level we bounce from here would be that recent high around $22.50.
And the risk. What's the line in the sand?
Risk management is key here. If the price breaks meaningfully below $16.50, the next major support level isn't until you get down into that $13 to $14 range. So that's your stop.
So to sum this all up, it feels like we have two completely separate realities. You've got the market narrative, focused on analyst reports and cash burn.
And then you have the physical reality. R2 validation units are rolling off the line. 1,500 VW engineers are testing the tech in the Arctic. The people with the most skin in the game are holding tight.
So the fundamental question for you, the listener, is this. Is $17 a share a reflection of old fears about the R1? Or is it a deep discount on the impending reality of the higher margin mass market R2?
And I'll leave you with a final thought to chew on. The R2 is absolutely critical for volume and profit. But it also pushes RIVN, which built this incredible premium adventurous brand with the R1. It pushes them squarely into the $45,000 mass market. How do they manage that transition? What does that do to their brand identity in the long run?
Don't forget to like, share, and subscribe for more.